Most traders understand options expire, but did you know you can be assigned early? Early exercise doesn't happen often, but when it does, it's usually around dividends, ex-dates, or expiration day pin risk. In this video, we'll unpack assignment and early exercise, why they happen, and how to prepare for them. What assignment means. Assignment is when the option seller has to fulfill their obligation. If you're short a call, you may have to deliver stock. If you're short a put, you may have to buy stock. Normally, assignment happens at expiration if your option is in the money. But sometimes it happens before expiration. That's early exercise. Why early exercise happens? Why would someone exercise early instead of waiting? Usually, it comes down to dividends. If a stock is going ex-dividend tomorrow, call holders might exercise to own the shares and capture the dividend. That means if you're short that call, you could get assigned the night before the X date. For puts, early exercise is rare, but can happen when they're deep in the money and the benefit of freeing up capital outweighs the time value left in the option. X dates and dividends in practice. To manage this, watch the ex-dividend calendar. If you're short calls on dividend-paying stocks, especially deep in the money, you're at higher risk. The more dividend value exceeds the remaining time value in the option, the more likely early exercise becomes. That's why many traders roll or close positions ahead of dividend dates. Pin risk at expiration. Another assignment danger is pin risk. This happens when the stock closes right at or near your option strike on expiration day. If you're short the 100 strike call and the stock closes at 100.01, you may or may not get assigned. If you're short the 100 strike put and it closes at 99.99, same story. Because assignment is random in these situations, you can end up with unexpected stock positions Monday morning. That's pin risk. How to manage assignment risk. Here's how pros handle assignment risk. Know dividend dates and close or roll short calls in danger zones. Check time value. If almost none is left, early exercise risk rises. Be cautious on expiration Fridays, especially when the stock pins near your strike. Size positions appropriately, so unexpected stock doesn't blow up your margin. Assignment isn't random luck. It follows clear incentives. If you understand those, you can avoid nasty surprises. To recap, assignment is part of options trading. Sellers must be ready. Early exercise usually happens around dividends or deep ITM options with little time value left. Pin risk at expiration can leave you with surprise stock positions. The key: track dividends, watch strikes, and manage risk proactively. That way, assignment won't catch you off guard. Thanks for joining us. If this breakdown helped you, hit like, subscribe for more trading insights, and comment below. Have you ever been caught by early exercise or pin risk?